Welcome to the weekly update, where I'll go over the action in the market for March 13th through March 17th, and then we'll see how things look for the week of March 20th through the 24th. There's been a lot of news hitting the market lately, especially with all this banking situation that's going on. It looked like things were getting a little bit better before Friday's session, but then a bunch more news came out. Now we have the weekend that's happening. What will come next? And that's really what's bothering the market. What we'll do is just pay attention to the charts day by day, adjust as needed. But right now, we're looking a lot more negative on the daily charts, and we're showing some weakness on the weekly charts, even though we were up on the week for the S&P 500. However, there are some areas of strength. The communications sector and the tech sector are doing quite well, while other sectors are really having some weakness, and I'll go through and talk about that in the video. Let's go back and talk about this week's session. I've got a lot of slides here to show you. For the week, banking worries continued to be a concern for the markets all week. Then way last Sunday, on March 12th, the Federal Reserve, the Treasury, the FDIC, they all got together and announced that all depositors at Silicon Valley Bank and Signature Bank of New York would be fully protected, even though both banks had been taken over by regulators. That was supposed to ease the market. The Fed also came in and said they're introducing the BTFP, the Bank Term Funding Program, that would help banks avoid selling securities at a loss. And that's kind of the backbone of what's happening now. These banks that got a huge influx of cash when we had all the stimulus sent out into the market, they didn't know what to do with it, so they just went in and bought treasuries. Well, that's fine if you hold them to maturity. As interest rates are going up, they're showing a loss for these investments. Some people see that information, they get a little concerned, they go into the bank, they start to pull their money out, and before you know it, you've got a whole lot of people pulling their money out. That's called a run on the bank. The bank runs out of money. What do? They have to sell some of these securities at a loss in order to generate some money to pay the depositors, and that kind of feeds into itself. The Fed then also came out and said these banks could offer those securities to the Fed, which will value them at par, what they would be worth if they were held to maturity, and they can use that as collateral. So the Fed is stepping in to try to help. This could end up backfiring on the Fed because of a situation that I'll talk about in just a minute. Another bank came into the news more at the forefront this week. First Republic Bank was the beneficiary when 11 banks made $30 billion of uninsured deposits into the bank. So this was the influx of capital that this bank needed. Not to be outdone by this news, First Republic Bank then announced that they were suspending their common share dividend. That's never a good sign. And that its borrowing from the Federal Reserve from March 10th through the 15th went anywhere from $20 billion up to $109 billion. So they need a lot of money. Also, banks borrowed $11.9 billion from the newly announced BTFP that I just talked about, and approximately $153 billion from the Fed, which really spooked investors. And this led to a lot of widespread selling in bank stocks. The Treasury market did quite well this week, where we saw a flight to safety. Folks were getting out of stocks and getting into bonds. And this is just producing a lot of economic concerns because of what's going on in the banking sector. And that's not the sector in the S&P sense. It's sector just in as a group of banks. Interest rates and oil ended up falling on the week. Then the European Bank, they came in and raised their rates 50 basis points despite a lot of trouble coming out of Switzerland when Credit Suisse fell 20% overnight. And they said they raised rates because inflation is projected to remain too high for too long, so they didn't really have a choice. That's coming ahead of what's going to happen this week with the Fed. Are they going to raise rates? Are they going to keep them the same? There's even some talk that they may cut rates because of this banking situation. Well, we have Monday and Tuesday and part of Wednesday to find out if any more news hits the market, and then the Fed will have a chance to react to that. So going back and looking at each day just briefly, on Monday, March 13th, the banking sector fallout caused market participants to be quite fearful. Price action in banking stocks suggested that regulators did not succeed in this. Remember the announcement that I said on March 12th? That was supposed to put the markets at ease. It really didn't do that. Then there's a fear that this whole problem could be bigger than previously thought. Then on Tuesday, the CPI wasn't worse than feared, so that gave a little support to the market. The S&P climbed almost up to its 200-day moving average at 39.39 at that time, before then declining for the rest of the day. Moody's ended up coming out and they downgraded the U.S. banking system to negative where it had been rated as stable. And then another geopolitical event was that a U.S. Air Force drone was forced down by a Russian fighter jet over the Black Sea. On Tuesday, we did see some late day strength, which kind of gave some hope to the market. Then on Wednesday, Credit Suisse, their largest shareholder, the Saudi National Bank, said that it cannot provide further financial help because of regulatory constraints. Later in the day, the Swiss National Bank came out and said Credit Suisse meets the capital and liquidity requirements imposed on systematically important banks. If necessary, just like the Fed, the SNB will provide Credit Suisse with liquidity. There were a lot more worries about banks because they're becoming more risk averse. They're tightening their lending standards and they're managing their balance sheets in a much more conservative way, so this could potentially slow economic growth and lead to further downward revisions in the earnings estimates. And that ended up putting some pressure on stocks. On the economic front, we had retail sales and PPI. They came in weaker than expected. Then on Thursday, sentiment really shifted, and we had a pretty powerful update that day. We did have a week open when banks were discussing this capital infusion into the First Republic Bank. Then later in the day, it was confirmed that 11 banks, including JP Morgan, Bank of America, big banks, would make uninsured deposits totaling $30 billion into First Republic. Also, Treasury Secretary Yellen told the Senate Finance Committee that Americans can feel confident that their deposits will be there when they need them. And this is producing what could be a backfire situation. These banks are now secure. Banks like Silicon Valley Bank to say, hey, we're safe. Come put your money with us. Doesn't matter. Even if you have more than $250,000, which is the FDIC limit, you could put $5 million in there, and the government has now come out and said they will guarantee that. So this could end up hurting other banks and take liquidity away from them. The market liked this private sector-led solution, and that helped really boost up prices on Thursday. Then on Friday, it was quadruple witching options expiration day, and that can make for some really wild times. There was a lot of pressure on the banking sector. First Republic received those cash infusions from the 11 big banks, totaling $30 billion. This relief that we saw from that was very short-lived, and then selling resumed not long after the open. It also came out that banks borrowed $11.9 billion from the BTFP, and then the record $153 billion from the Fed, and that even goes above what was borrowed during the financial crisis. So there was a lot of renewed worries about the health of the banking industry. Now we have to see what comes next. Is there another shoe left to drop? On a positive note, the big stocks, Apple, Microsoft, and so forth, they did quite well in Friday's session. So for the week, the S&P ended up being up 1.43% on above average volume. And the technicals, they're shifting more negative on the weekly charts. We've gone full-blown negative right now on the daily charts, and we're not showing really much of anything extreme negative right now. So if we're going to go down, it has some more room to run to the downside before it becomes oversold. The markets are continued to be fixated on this inflation and interest rate scenario, but right now this whole banking situation is really taking over the market. Our trend is weakening. We're below 20. It is declining. We're also in a trendless environment on the daily charts. Here's the intraday chart. I don't have much data for Monday. StockCharts.com had problems with their intraday data, and it just got fixed later in the day. But then on Tuesday, we had a little bit of a higher open. We went all the way up and almost reached the 200-day moving average, and then we fell back. But then we saw some late-day strength coming into the market. On Wednesday, we just kind of chopped around a little bit, but ended up going up a little higher. Thursday was the real powerful day. We actually opened lower and then spent the rest of the day just going higher. But then on Friday, we gave back a lot of those gains. Just to review where we were at on Friday, March 3rd, it looked like we were getting a 25 basis point hike at the next Fed meeting. Then Chair Powell came out. It switched to 50 basis points. As of Friday, we're back down to the 25 basis point probability. And you can see over on the left that there's even a 38% chance that the Fed might even leave rates unchanged. Looking at the consumer sentiment that came out, it ticked down a little bit at 63.4. There's still a really wide spread between the 2-year yield and consumer sentiment, where these tend to go in the same direction. They tend to not get too far apart from each other, but now they've been far apart for quite a while, and they're not really going in the same direction. Even though the 2-year yield has come down a bit, it hasn't done that much to help with the consumer sentiment. The Dow was down 0.1% on the week. The Nasdaq was up the strongest. It was up 4.4%. The S&P was up 1.4%, but small caps just got hammered. They were down 2.6%. Here's a look at the week showing how the Nasdaq and the Nasdaq 100 did the best, followed by the S&P 500. The Dow was just barely positive over the last 5 trading days. And then small caps, the NYSE and mid caps just got taken out and shot. Going back to the beginning of the year, the Nasdaq 100 and the Nasdaq are doing the best, followed by the S&P 500, where you have all the rest of the indexes now are negative. Then going back to the all-time high, all of the indexes continue to be negative. The Nasdaq 100 and the Nasdaq are paring some of their losses, but they're still down heavy overall. Looking at all the sectors, some were up, some were down. We had tech, communication, and utilities, followed by discretionary, staples, and healthcare were up. Real estate was virtually unchanged, but then we saw industrials, materials, financials, and energy really down big time on the week. Here's a look at the relative rotation graph showing how communication and tech have really come into the leading area, where all of these red lines are showing weakness with the utilities, the staples, healthcare, energy. It's kind of right underneath this red line here, but this is the financials. And there's a lot of other areas that are really showing weakness right now. So we're seeing a real shift over into areas that really suffered in 2022. We'll have to see. Can they come to a leadership role and actually help to take the market higher? Now, my understanding is that a lot of these communication and tech areas are experiencing some favor right now because they're not really connected to all the banking problems that are going on right now. We're also seeing a lot of improvement currently with discretionary. Real estate is rolling over a bit, but it's still showing some improvement. Then for the week, we had communication, tech, utilities were up. The areas that were down, real estate, industrials, financials, that's a big one, materials as well as energy. Then going back to the beginning of the year, we have tech, communication, and discretionary doing the best, or all of the other sectors are negative. And then if you go back to the all-time high, it's still energy that's doing the best, even though it's giving back a lot of its gains. Looking at sentiment, we worked our way down to an extreme negative reading. Right now we're at 25. Here's the historical chart showing how we've really come down as the market's been coming down. The VIX with the line chart really shot up, so it's showing that this fear is being noticed in the market finally after being very complacent. The bar chart is also going higher. Then the active asset managers, now this is a week old, and we had a pretty difficult Friday, last Friday, the 10th of March, followed by a pretty difficult week. So we're seeing a real decrease in the positions of the active asset managers, but still down in about a neutral reading. The Ridex bull-bear ratio, you see a lot more people getting into the bearish funds over the bullish funds as the market's been having some trouble. This is also a week old. This is the American Association of Individual Investors. They are now extreme negative on the market. The Ulster Index is below the moving average and ticking back up, where we're slightly above the moving average on the daily chart. Looking at the economy, and I have some new charts to show you. This is the spread between risky and non-risky loans. And even though it's going back up, we're not really giving a real high reading currently. So this just suggests as of Friday that things are still under control. Then we also look at the National Financial Conditions Index. We're still below this black line, so things are staying under control that way. Then we look at the tightening standards, which this has not been updated since February 6th. But it just shows the banks are getting a lot more strict with their tightening standards. Then here's a new one. This is called the Real-Time Solemn Rule Recession Indicator. When we go above this red line, that means that the economy's running into trouble. Well, we're still below this black line. And this was updated as of March 10th. And then updated on March 3rd is another thing called the Smooth U.S. Recession Probabilities. When we get up to this red line, that means that there's a real high probability that we will go into a recession, and this is just barely above the black line. And then another thing called the Brave Butters Kelly Leading Index. This is actually showing a little bit of an advance, but this hasn't been updated since February 27th. And then this is kind of interesting too. This is the liabilities and capital. These are the earning remittances due to the U.S. Treasury, and they take this every Wednesday. This is how's the Fed doing right now. When they're above this black line, that means they're making money. Well, look how it's really trailing off since the latter part of 2022, and this was updated as of March 16th. Looking at inflation, we have our inflation nowcasting where the CPI inflation actually ticked down just a little bit, but we're still going pretty much sideways. Another thing that you might hear as people talk about this situation is, even though the Fed hasn't adapted this quantitative easing policy, look at what's happening to the balance sheet as they're putting all this money into the U.S. banking system. It's actually going up, and that is a form of quantitative easing, where they had been lowering the balance sheet. Now it's starting to go back up. And that's producing a lot of concern in the market as well. Then looking at breadth, we're just below the moving average based on price, and we've tucked below the moving average based on volume. The advanced decline ratio is below 0 and declining, so that's negative. The new highs and the new lows, we're starting to see a bit of an expansion of the new lows. So our 4-period moving average is declining, and we're also declining with our 10-period moving average. Accumulation distribution, this is still hanging in there. It's above the moving average and slightly going up for the week. Looking at our trend, we're below 20. The ADX is below the moving average. It's trying to turn back up, but it hasn't crossed yet. And the red line is now on top, so we default to negative. The Arun didn't really change this past week. Buyers were really in control there for a while, and sellers were decreasing. So our oscillator was unchanged on the week, but it's still above 0. Where we're below 0, just coming off an extreme negative reading on the daily chart. The mass index is not generating a signal right now. Then looking at the daily chart, we're still above this declining trend line. You can see over the last number of days where volume really picked up. Here's a 2-year look at that same chart where we're now below the 200-week moving average. And we're starting to break down a little bit below the midpoint of the trend channel going back to 2009. We're also below the monthly pivot, even though we had an up week. This still slants more to the negative side. We're below the 50-period moving average, which equates to a 200-day moving average on a daily chart. Our long-term trend, we're not really getting a golden cross yet. We dropped below both moving averages, but there hasn't been a golden cross yet. The bullish percent index is starting to get extreme negative and still has more room to fall, and we're seeing almost this identical reading on the daily chart. Chaikin oscillator, this is positive. It's still above 0 and turned up over the past week. The Chaikin money flow is still positive even though it is declining. The force index is right at the 0 line, so it's virtually neutral. The McClellan oscillator, after giving us an extreme negative reading, has bounced up out of that. And the summation index based on price and volume are below 0 and continue to decline. The oscillator chart shows the slope declining, the TSI still going down, the MACD, the PMO. They're all rolling over pretty much, but our longer-term moving averages, they haven't quite rolled over yet and are still positive. The Swanland trading oscillator is still below 0 based on price and volume, even though it did tick up this past week. The PMO study is still positive overall, but the price and volume indicators are below 0 and declining. The PMOs that are rising after giving us an extreme negative have now bounced up out of that. We're just barely coming over the line with the PMOs that are giving buy signals, but we're still declining with the PMOs that are above 0. The RSI is still below 50. That's negative, but it did tick up slightly. The Special K is still positive overall, and we're getting close to that moving average. The Stochk RSI is still just barely extreme negative. The Williams percent R is not extreme negative, but below 50, but it did advance this past week. The Vortex indicator has the red line going over the green line, so that is negative. The ultimate oscillator is below 50 and pretty much unchanged, so that's negative still. The money flow indicator is below 50 and declining. That's negative. The percent B indicator is still below 0, even though it did tick up, but that's still negative overall. The rate of change going back 1 week, since we had an up week, we were above the dashed line. If you go back 50 weeks, we're pretty much sideways. The Kopik curve, which is generating a signal on the daily chart, is not generating a signal right now on the weekly chart. Looking at the weekly chart of our fib levels, this support level has held so far, and this is at about the 38.12 level or so. If we fall below that, then we may come all the way down to the moving average, which is currently at 37.31. Looking at our different charts, Heiken and Ashi were negative with black candles. The Kegi is still positive. It's black, but that means positive on this chart, even though it is declining. The Renko is positive with an open box. The equi volume going back 1 week is still negative overall, and we're declining below the midpoint with the 14-day ease of movement indicator. No change in the point and figure chart. The 3-line break is still positive with open bars. The elder impulse system continues to be negative. The parabolic SAR still has the dots on top, so that is negative also. Looking at some broad market indications where we have the S&P holding up a little bit better, where we're seeing some weakness now in the mid caps and in the small caps. All stocks, after giving a recent golden cross, has been falling back and is now below both of the moving averages. The mid caps, and you're going to hear a broken record here. Recent golden cross, then a lot of weakness. Recent golden cross, weakness with the small caps. The Dow, recent golden cross, weakness. The NASDAQ, holding up a lot better, but we haven't been able to see a golden cross yet on the weekly chart. We're getting very close on the daily chart. The NASDAQ 100 has given us a golden cross, and we're getting close to that here on the weekly chart. The Wilshire, getting close to a golden cross, but then we see some weakness. The NYSE, recent golden cross and weakness. FANG stocks, also getting close to giving us a golden cross on the weekly chart, where we have seen a golden cross on the daily chart. ARC not getting close, really, either way. We're still in a downtrend overall. The biggest software companies getting close to a golden cross, but also seeing some weakness. Then looking at the bank index, where we've really just seen a real downturn in this. In fact, we've gone down so far so fast that up above the RSI 9 is now getting extreme negative, or if you look on the bottom, the MACD is clearly in a downtrend. Then looking at Dow theory, we have the Dow, the transports falling a little bit more than the Dow, and we're seeing a little bit more weakness currently in the utilities. Then at the broad market, we have the CRB index, recent death cross, and showing some continued weakness. Copper, still in an overall uptrend, both on the daily and weekly chart, but it's been getting smashed around quite a bit over this past week. Gold, which a lot of people say, okay, here it is. This is when it's going to happen now. Forget about Saturday and Sunday. Go buy gold right now, because we're just going to shoot up, and it's going to open up on Monday above 2,000 and go above 2,100 to its all-time high, and everybody's going to be happy about that. Well, it is in an overall uptrend, and it is going to the upside. Just how much strength this is going to see, we don't really know yet. And the same thing with silver. Showed a lot of weakness lately, but it's starting to bounce back. This is seen as a hedge against insanity, and that's what the market's kind of worried about right now. Oil is really dropping down to $66.93 at Friday's close. The dollar also declined this past week. Looking at bonds and interest rates, where bonds have been doing quite well. We're still in a downtrend overall on the weekly chart. We're in an uptrend on the daily chart with our bond ETF. And then the yields, after really going up, this is a daily chart, and then they've really been coming down as folks are getting out of stocks and getting into bonds. Looking at the MOVE index, which is the VIX for bonds, it's really been spiking up and kind of going crazy as the market's been gyrating. Then looking at international rates, where we see the US, the UK, and German rates are actually coming down. Japanese rates are also coming down as well, and they're still in their own little scenario that we're watching to see if anything breaks with that. Looking at some relative studies where oil has just been the king over the last year, it's now dropped down below the return on the dollar going back to the beginning of 2022. Gold is really starting to turn back up, where we still have stocks and bonds that are negative. The bond to S&P 500 ratios peaking out a little bit here and showing some strength as of late. And the stock to bond ratio is really showing how stocks have been starting to underperform bonds. Still in an overall uptrend, but it is falling back. The gold to the US dollar ratio, gold has just been going up as the dollar's been going down, so this ratio is going up. And then gold to the S&P is also breaking out to the upside. Then we have the low volatility stocks to the S&P, where they pretty much are chopping sideways. And then growth value, we're seeing a real improvement in growth, but it's still in an overall downtrend on the weekly chart. The NASDAQ 100 is really outperforming the S&P 500, but we're not back yet to a golden cross with the ratio. And the S&P 100 is really outperforming the S&P 500, but not back to a golden cross yet. Discretionary, although showing some improvement and then falling back lately, is still in an overall downtrend. And then energy, which had been doing really well and was really outperforming tech, we're starting to see that change right now. Then looking at some of our longer term studies, again, going back to the lows in October 2022, we had an extreme negative reading here, and then we bounced up off of that. Now, we've been coming back down, but if you look out 1 to 2 to 3 years after this signal has been generated, it has a perfect track record. It might be just a nightmare between now and then, but at least you'll have some kind of a positive return if you are willing to hold on for the longer term. Then looking at our momentum studies, again, this goes back to 1998 through 2004, where we saw a couple of fake outs, which we may be seeing right now, where it looked like we broke above this downward sloping trend line 2 times, but if you look down at the bottom, you see where the MACD was not doing very well. It turned up, but it didn't ever cross back above 0. Then again, it was declining. It came back up, was showing some improvement, but did not get above 0. Then we look at 2007 through 2010, where it looked like we were breaking out of this downward sloping trend line again, but the MACD was pretty much flat, and then after that, we saw some real weakness in the market. Now we look at the present day. Right now, this is looking like a fake out where we were coming back above this trend line, and we're still above it after Friday's close, but look at the MACD down on the bottom. It's just getting ready to cross over negative. So we're going to be watching that, and I'm showing this every day in the daily video updates. So what's the outlook for the upcoming week? We don't have any economic reports coming out on Monday, but on Tuesday, we'll get existing home sales. Then on Wednesday, the MBA Mortgage Applications Index. This is when the Fed's going to come out and make their announcement, and then they'll have a press conference after that. Then on Thursday, we have our weekly jobless claims and then new home sales. Friday will be durable goods, and then the IHS market manufacturing, as well as the services PMI preliminary reports. So our technicals are turning more negative, even though we had an up week. We have to be aware of this whole banking situation that's going on. That doesn't take away from the communication and the tech that are actually doing quite a bit better. But the markets overall are still fixated on this inflation and interest rate scenario and this whole banking problem. We don't know if there's going to be more stories that come out that really rattle the markets. And then on this upcoming week, we will get some Fed speak as well as policy when they make their announcement on Wednesday. And that's what this next slide covers, is it'll be at 2 p.m. Eastern time when they do make their announcement. And then there'll be the press conference after that, and the markets will be hanging on every word. Looking at the Stock Traders Almanac statistics for Monday, March 20th, we're neutral to positive with the Dow being up a little more than half the time. The S&P is more negative, where it's only up 42.9% of the time, where the NASDAQ is up 66.7% of the time. And then all these other areas that are supposedly providing a positive backdrop, but we're just not seeing a follow-through based on price, at least yet. On Monday, we will have the 14th trading day of the month, where that tends to be positive for the S&P. If you follow the dashed green line, because that measures the pre-election S&P 500 returns. Then we're supposedly coming into this sweet spot now that we're about in the midpoint of the month, where we should be seeing some strength, and we're trying to follow along this gray line that's up on top, which is a pre-election return after we've had a midterm bear. And then we're also supposed to be in this sweet spot right now for the S&P 500, but we're just not seeing that yet. The scenarios for Monday, you could go with the down one, but we're not trending and the ADX is below 20. Even though the technicals are negative. Definitely can't go with the up one for Monday because we are negative overall. So we're defaulting back over to the sideways trend. The ADX is weakening. It's below 20. The red line's still on top, so it is negative. This is from an email received from earningbeats.com, where the sector that is hot in the month of March tends to be the utilities, where the financials are not. And isn't that playing out kind of interesting? We're past March 1st through the 5th and then the 6th through the 9th. Now we're coming into more this middle point where the market might see some return, but then when we get later into the month, it's pretty much flat to slightly negative. Thank you. I hope you found this helpful. Please feel free to check out the daily brief. Also, I do post these videos every day, and I will be going through and updating things about the banking situation if any more news breaks with that. I'll also be posting the intermarket analysis video as well as the deep dive video and the supplemental video. So have a great weekend, and I will talk to you in the next video.